Hi, this is Jim Sackman, your Focal Point Business Coach, and this is another of our Success Friday videos. And we're continuing our theory of our theme of franchising your business, and we're going to talk about venture capitalists. And venture capitalists have a very poor public perception, but seem to be quite popular because many people want their money. So, it's kind of a mixed bag for them. Now, a VC themselves generally works for a firm, and a firm will have one or more funds. And those funds are collected from outside people. Generally, they're not the VC themselves, but those people are executives that help invest the fund, which is derived from third-party sources. Now, because of that, the fund first off will have some sort of limitations. Those limitations will be geography, or they'll be size of company or industry that the company's in, the state of the business, some set of limitations on the kinds of companies they can invest in. On top of that, there's a time frame for the fund. They're going to want to have the funds, the actual money put into the fund, back to the investors at some point in the future. That means usually there's a time frame under which the investments happen, and there's also a time frame for which they think the returns are going to happen. And all of that is grist for the mill for this group called the investment committee. And the investment committee is a group of senior people at the fund in the firm that evaluate whether an actual investment will be made or not. So when you walk into a VC, they're not going to make a decision on the spot. They're going to have somebody that negotiates or proposes a deal, brings that to an investment committee, and the investment committee will be the people that actually say yes or no. A couple things about this, and one of the reasons that they're both popular and unpopular is they're willing to invest oftentimes in early stage companies. The challenge is they want a lot for their investment. Now, much of the time you're going to expect to take, as a group, as a total group, a majority ownership position. Remember, these are people that think they're smarter about investing than the business owners themselves. So they want the professionals to be in charge. And so they view the entrepreneur as inherently optimistic, and they want sort of people with larger, broader experience to be in control of the business. So you can expect them to want to own a majority of the stock as a group and have the majority number of seats on the board of directors. The other thing that you can say is they're really all about the liquidity event or the exit of the business. Now, the VC, because it's got that time frame to return the money to investors, wants an opportunity to provide money in a return to the investors so that they can get more. And the best way to do that is to get a good return, a good exit on a percentage of their investments, whether that's through an initial public offering or an IPO or through a sale of the business. Either way, the VC fund is hoping to get a multiple on its original investment and justify its taking a percentage of the profit to run the fund and pay all the employees. So that's it. That's a brief overview of venture capitalists. And next week I hope to talk about valuations. So this is Jim Sackman from Focal Point. Change your business, change your life, and have a great day.